Hello, this is Jordan, and this is your Precious Metals video market update. This video is being recorded on the very late evening of Thursday, June 15th, 2017. And in this video, I am going to discuss why I see increasing downside risk for the precious metals sector. And starting off, we'll take a look at a chart that we had in our last video update 2 to 3 weeks ago, and this is the weekly candlestick chart for gold. And as always, we show the key resistance at 1300, the resistance above that just around 1350, that trend line that goes back to the 2013 and 2014 highs. And that, to me, I mean, these two resistance lines, these are really the key lines for gold, not the ones that are being drawn from the 2011 high. Because if you look at gold, I mean, since it crashed in early 2013, it's been trying to bottom, or it's been in this big, wide, very large bottoming formation. And so the trend lines from 2013 to 2014, and then the one going back across 1300 going back a couple years, those are the real significant trend lines, in my opinion. Now, the previous week ended with a bearish reversal because gold went to 1297 intraday, and well, actually I believe on the daily chart gold closed at 1297, which was above its daily closing high in the spring of 1294. But if you look on a weekly basis, gold closed, it made a bearish reversal. So 2 weeks ago gold actually closed down for the week. It made a bearish reversal. So if you look on the weekly chart, gold never made a new high. And then this week we're seeing more downside follow through. We should also note, I mean, the bearish reversal occurred near major resistance at 1300. So, I mean, that's bearish action there. Excuse me. Now, as far as where we are now, let's focus on the long-term moving average support. I mean, that's coming in around 1220, 1230, and if you draw a trend line, it may be difficult to see, but a trend line from the late January low, you connect that from the other recent lows, that's coming into play around 1230. So the problem for gold is if gold breaks below all this support, right above 1200, but 1220, 1230, I mean, once gold breaks that, and if it breaks it in convincing fashion, then we're probably going to see a move down to the mid 1100s, or maybe even a little bit lower by the December low. And just if you look at the big picture, which we have, right up here, the action since last December, that looks like a counter trend move. I mean, that does not look bullish. Gold, it's making a lower high. That doesn't mean that we're going to make a new low below 1050. I mean, that doesn't mean that the 1050 low isn't significant. But I mean, it's clear to me that over the last 6 or 7 months, that looks like bearish action in the bigger picture. Now, another thing to add on top of that, at the bottom, I have the GVZ, which you can actually trade. That's a contract like the VIX. It basically is the gold VIX. And there's the ATR indicator. That's another volatility indicator. So these volatility indicators are actually at multi-year lows. I didn't want to stretch the chart back too far, but GVZ only goes back to 2010, and it's the lowest that it's ever been right now, basically. ATR, I think, is the lowest since 2008. So we're looking at, for both these things, we're looking at 8 or 9 year lows. I mean, that's extremely significant low volatility. And so what I'm worried about is a long-term gold bull, is that we could see gold break the support I was talking about, then volatility starts to pick up and increase, then you get an even bigger move down. So we have to be very cognizant of that. It's a very dangerous looking situation. And as I've also mentioned in past videos and past editorials, gold has been the strongest part of the sector. I mean, silver looks textbook bearish. The miners, obviously, I mean, silver and the miners did not confirm gold's strength in recent months. So the fact that gold looks bearish just looks like it's going to follow the rest of the sector, which has been even more bearish recently. Now, on the fundamental side, I know we're getting long for this slide, but on the fundamental side, the problem is real interest rates have actually increased around 1% in the last 3-4 months. So real interest rates actually peaked 3 or 4 months ago. And that's because inflation's coming down. The Fed has raised several more times, and that's a negative for gold. And look, several months ago, the real Fed funds rate was it was nearly minus 2%. Now it's around minus 1%. And if the Fed hikes one more time this year, then the Fed funds rate gets up to 1.5%. Inflation was 1.8 at the last reading. What happens if inflation goes to 1.3 or 1.2? I mean, then the real Fed funds rate is it's positive. It's plus 0.2, plus 0.3%, which doesn't sound like much, but if it was 2% 3 or 4 months ago, that is a big negative fundamental change for gold. So that really worries me. So I'm worried on a technical and a fundamental basis, but let's get to the other charts. And I don't want to spend a lot of time here, but this is just looking at gold compared to some other asset classes. And, gold made the false new high. I mean, it wasn't there was a negative divergence if you're looking at gold against foreign currencies. And also gold against the equity market. I mean, there were strong negative divergences there. Gold made a false new high on the daily chart, but if you look at gold against other asset classes, didn't even come close to going above its April high. And I didn't even show gold against bonds, which also made a lower high. So gold's recent strength was really dollar-based. I mean, when gold is rising and it's in a real bull market, it should be a broad-based move where it's rising in dollar terms and foreign currency terms. I mean, it's outperforming most asset classes. That's what you want to see. And so recently, that did not happen in the last couple months. That was a warning sign. And I already mentioned silver, but silver looks a lot worse. The rally failed at the 200-day moving average. So silver looks like it's been leading gold because gold now looks like it's going to follow silver lower. Here we show the weekly bar charts for GDX and GDXJ. GDX has been, since February when it peaked, it's been consolidating in this descending triangle. Now, if you look at the weekly chart, I mean, unless it has some massive rebound on Friday, it's going to have a very bearish-looking candle for the week. If you look at the last 3 or 4 weeks, I mean, those candlesticks, they imply distribution. And GDX is also below, I mean, it's below the 20-day moving average, it's below the 50-day and 200-day. Not good. So it has a lot, its downside momentum is picking up. Probably should test 21 in the next couple days. And look, that descending triangle pattern, if GDX breaks below 21 and it's a clear and strong break, the measured downside target of that is around 17. So that's even below the December low. So, I mean, it's possible that we could see the miners go down to the December lows in the next month. Then they rally. They rally for another month or two into September. Then perhaps after that they go even lower than the December lows. So just because the downside target is 17 or around 17, that doesn't mean it's going to happen in the next month or two. You could still see weakness and then a rebound for a couple months in there before it eventually gets down to that target. But I mean, it's clear for long-term traders and investors. I mean, this is a clear bearish outlook right now. There's too much risk here. You want to wait until miners get down to those blue lines and they're really oversold. GDXJ, I know the industry is really counting on a rebound because of the rebalancing, but if you look, GDXJ in the last couple months has outperformed, not the last couple months, but the last 2 weeks or so, it's outperformed GDX. And juniors in the GDXJ, they were really lagging before the news of the rebalancing, before the announcement. So I don't think we can blame the rebalancing for the reason why GDXJ and the juniors have been so weak. I mean, maybe it's part of it, but regardless, I mean, the facts of the matter are, if we're going to see gold break down and GDX is going to break down out of the triangle, GDXJ is going to go lower. I mean, if GDX drops 10%, maybe GDXJ will only drop 6 or 7% in the best case. But with the way things are still set up here and now, you don't want to be betting on this rebalancing, this bullish move after the fact that the industry seems to be counting on. I would be very wary of that. until it actually, until we see some bullish developments in the charts, which I don't see happening. And here's another chart. This is this is actually the smaller half of my 55 stock junior index. So there's actually 26 stocks in this index, equally weighted. The market caps are in the vicinity of 50 million to 250 million. This index has been much stronger than GDXJ, and this index has been a strong part of the sector, and it's been battling at the 200-day moving average. First it failed in April, and now it's failed at the 200-day moving average. 1, 2, 3, 4, 5, a handful of times in just the last month. And the 200-day moving average is sloping down. The 50-day moving average is sloping down. The index has come below that. So that's a very bearish development. A lot of buying here has been exhausted. And so this index has 8% downside to the May low, which is the first support area, but about 23% downside to the December low. So again, not saying that's going to happen in the next month or even the 2 months after that, but it's a target that you can't ignore. The charts are the charts. I know that some people don't like technical analysis and they don't believe it works, but we're measuring supply and demand here, and the weight of the evidence as far as technical analysis and also sentiment. We could do a whole nother video on sentiment, but people are not that bearish. They were a couple months ago, but people are not. Most people, if you read or follow most people in the industry, they're not looking for a big drop now. So it's worrisome to me. The way things are setting up here, I see a lot of downside risk in the next couple weeks, potentially the next couple months. So this is not a time to be buying. This is not a time to be aggressive. This is a time to be cautious, raise cash, get defensive if you can. And, when these things come down and when they get really oversold, that'll be the time to buy. But it's not time right now. Thank you so much for tuning into this video. You can follow all of my work at thedailygold.com. Consider my premium newsletter. It's only $149 for 6 months. thedailygold.com/premium. We focus on market timing and stock selection. We want to pick the right juniors. If you really want to know which are the best juniors out there, which are the ones that really have a chance to make big returns in the future, consider signing up for our service. We can help you out. We have contacts in the industry. We talk to geologists. We find out which deposits have legitimate potential and which are the companies that are just moving on hype and promotion. And our model portfolio is a real brokerage portfolio. Everything we buy, we're buying for ourselves. So hopefully you'll consider looking at our premium service. I think it can really help you in the months ahead as we navigate the potential downside here that I see coming. Thanks everybody for listening and watching this video. And I look forward to publishing another update for you in the next couple weeks. Thanks.